You know that specific kind of paralysis you get when you're finally trying to be a responsible adult with your money?
Oh, yeah. It's usually, what, 11:30 at night?
Exactly. 11:30 at night.
The witching hour for financial anxiety.
Right, you're sitting there, the blue light from your phone is just blasting your retinas, and you're doom scrolling.
Yeah.
And you realize your current checking account is earning basically 0.0 nothing percent interest.
It's always 0.01.
Yeah, essentially nothing. And you decide, okay, that's it. I'm fixing this. I am going to find a high-yield savings account.
It feels like the responsible next step, right?
Yeah,
Like it's the ultimate adulting move.
totally. So you Google best savings rates,
Naturally.
and you inevitably land on one of those lists. You know the ones I'm talking about, with the neat little rows.
Oh, the very clean tables.
Yeah.
Bold percentages.
Hold percentages, maybe some star ratings, and those big green apply now buttons.
They make it look so simple.
Yeah.
Frictionless.
Exactly. It looks so objective. You just think, great, I'll just pick the winner at the top of the list and I'm done.
Which is exactly how it's designed to look. You just pick the highest number and move on.
But we got our hands on a document this week for this deep dive that completely shattered that illusion for me.
It really pulls the curtain back.
It does. It's titled Embrace Yourself, because this sounds incredibly dry.
Oh, it's a mouthful.
It's called the Financial Deposit Ranking Methodology and Inclusion Criteria.
Which sounds like a guaranteed cure for insomnia.
It really does. But once you start reading it, it's actually a recipe book.
Right.
It's the secret sauce for how those best of lists are actually made.
Yeah, and it turns out that simple list on your screen is the survivor of a brutal daily Hunger Games.
100 games. That is not an exaggeration.
No, not at all. We are talking about a massive data operation here.
Right.
This isn't just, two guys in a basement googling banks and throwing darts at a board.
No, the scale is wild. The source outlines a team tracking something like 200 institutions.
Banks and credit unions.
Right. Every single business day. They're monitoring rates across multiple time zones, scrubbing data on 100 high-yield savings accounts, 60 money market accounts, and something like 200 CD providers.
It's a massive intake of data.
And the goal of our deep dive today isn't to tell you, the listener, to go bank with Bank X or avoid Bank Y.
No, definitely not.
We want to reverse engineer the machine. We want to show you how the experts filter out the noise.
Because once you understand the rules they use to disqualify banks, you can spot a marketing trap from a mile away.
And there are so many traps.
So many.
It's actually kind of impressive how creative these banks get.
It really is.
So let's peel back the curtain. The document starts with what they call table stakes.
The bare minimums.
Right. Before a bank can even dream of getting a gold star or a #1 ranking, it has to get past the velvet rope.
Exactly. And the bounce with the door is checking for two things. The first one is non-negotiable. And honestly, it should be non-negotiable for you too. Federal insurance.
This is the safety net.
Precisely. If it's a bank, it must be FDIC insured. If it's a credit union, it has to be NCUA.
Okay.
The methodology is incredibly strict here. It doesn't matter if a bank offers you 10% interest. If that federal seal isn't there, the bank basically doesn't exist to this ranking system.
Because that insurance covers you up to $250,000 per person per institution.
Correct. And that's per ownership category too. It's the bedrock of confidence.
Right.
If the bank fails, the government steps in. Without that, you aren't saving. You're gambling.
And the methodology is very clear. We do not rank gambling.
Exactly.
Okay, so that's the obvious one. But the second criteria for getting on the list is where I got a little confused.
Nationwide rule.
Yeah, it says the institution must be available nationwide.
Sounds simple enough.
It does, but when I hear nationwide, I think 50 states. If I can't bank there from Idaho, you aren't nationwide.
Right.
But the source material says close enough counts.
Yeah, it's a game of thresholds. The methodology defines nationwide as serving customers in at least 40 states.
Wait, 40? So you can explicitly ban customers from 10 entire states and still be called a national bank in these rankings?
Yes. They usually mark those with an asterisk, but they make the cut.
That's fascinating.
It's a concession to the really complex web of state-by-state banking regulations. If they demanded 50-state perfect compliance for every single institution, the list of high-yield options would shrink dramatically.
Right, there'd be nothing left to rank.
Exactly. They'd rather give you a great rate that works for 80% of the country than hide it because of a paperwork issue in one state.
That makes sense. It's about not letting perfect be the enemy of the good.
Right.
But speaking of availability, this brings us to the biggest hurdle I usually run into, Credit unions.
Yes, the field of membership.
Exactly. I see a great rate at a credit union, click the link, and it says something like, you must live in this specific county in Ohio.
Or you must be an employee of this specific airline.
Right. I usually just close the tab immediately because I assume I can't join.
And historically, that was the end of the road. But this methodology highlights a massive loophole, or really a feature, that allows them to rank credit unions alongside the big banks like Chase or Wells Fargo.
Okay.
They specifically look for credit unions that offer a backdoor.
A backdoor. That sounds illicit.
It's perfectly legal, I promise.
Okay, good.
It's formally known as joining via a nonprofit affiliate. Let's say there is a credit union that technically requires you to be a member of the, I don't know, Save the Sea Turtles Foundation.
Or a specific library association. I've seen that one.
Exactly.
Okay, so I have to go join a library in a state I don't live in.
Usually, it's easier than that. Often, you can join that foundation or library right during the credit union application process.
Oh, really?
Yeah. You tick a box, pay a small donation fee, and suddenly, congratulations, you are eligible for the credit union.
So I donate to the Turtles, and in exchange, I get access to a 5% interest rate.
Exactly. It turns a local institution into a national one.
That's amazing.
But, and this is a huge, but in the ranking rules, they put a strict price cap on this backdoor.
They limit how much the donation can be.
Very strictly. The methodology only includes credit unions where that joining fee or donation is under $40.
Under $40? That is such a specific number.
Or free, of course.
Right, but why 40? Why not 50?
It's about the erosion of value. Think about the math.
Okay.
If you have to pay $100 or $200 just to open the account, that fee eats up your first few months of interest.
Oh, right. It defeats the whole purpose of a high yield.
Exactly. So if the entry fee is $45, disqualified, cut from the list.
I love that. It's protecting the user from doing bad math.
It levels the playing field. It ensures that a credit union is actually competitive with a free-to-open online bank account.
Yeah.
They're essentially saying, we'll show you this rate, but only if the covered charge is reasonable.
Okay, so we've made it past the bouncer. We're insured. We're nationwide mostly, and we didn't pay more than $40 to get in.
We're in the club?
We're in. But now we have to figure out what we are actually opening, and this is where I feel like the banks are actively trying to confuse me.
Oh, the terminology game.
Yes. Savings account versus money market account.
Right.
In my head, they're basically the exact same thing. It's a bucket. I
Hey.
put money in the bucket, it grows.
That's how most people see it.
But the ranking methodology treats them as completely different species.
They do. In the marketing brochures, they blend together. Banks love to use interchangeable terms to sound fancy.
Right.
But in the data analysis, there is a hard line in the sand, a single feature that defines the difference.
Which is?
Check writing privileges.
Checks.
Checks.
That feels remarkably retro. I don't think I've written a check in 3 years.
It does feel retro, doesn't it?
Yeah.
But it's the ultimate definition of liquidity for these accounts. According to their rules, a savings account has no check writing capabilities. A money market account, or MMA, must have check writing privileges.
But wait, I've definitely seen accounts advertised as a money market savings that don't give you a checkbook.
And that is exactly what the methodology identifies as a marketing trap.
Really?
Yes. The document is brutal about this. It essentially says, we don't care what you call it.
So if a bank slaps a fancy money market label on an account to make it sound premium or sophisticated, but you can't write a check against it?
The rankers strip away the label and throw it right into the general savings pile.
That is deeply satisfying. It's like the sorting hat of banking.
It's all about utility. The reason money market accounts traditionally paid slightly different rates was that liquidity feature.
Right, the ability to pay a bill directly from the account.
Or write a check to a contractor. If a bank removes that feature but keeps the name, they're just using jargon to try and stand out. This methodology corrects for that.
That is so good to know. Now, there's another filter here that I found really interesting because it touches on the whole fintech explosion.
The app-only banks.
Right. We have all these app-only banks now. Some don't even have a website you can log into on a desktop computer.
The document calls this the app gap.
The app gap. Does the ranking system care if a bank is app-only?
It cares if they are exclusive within that app world.
What do you mean?
The rule is, if an account is accessible only through a mobile app, it absolutely must be available on both iOS and Android.
So if trendy new startup launches and says, we're iPhone only for now, sorry, Android users.
Instant disqualification. They do not make the list.
Wow. That seems a little harsh, but I guess it goes back to the nationwide rule.
Exactly. If you are excluding half the smartphone market, you aren't truly available to the general public.
You're just a niche product.
Right. And these rankings are for the general consumer. It forces these fintech companies to be inclusive if they want the visibility of a top-tier ranking.
Okay, one last hurdle on the savings and MMA front before we switch gears to CDs. I noticed a rule about balance caps.
Ah, yes.
This one felt personal because I see it all the time.
This is the teaser rate killer.
Yes. You see an ad that says, earn 10% APY.
And you get all excited.
You click the link, and then the fine print says, on your first $500.
It's essentially clickbait in banking form.
It really is.
The methodology creates a floor to filter this junk out.
How does it work?
First, to be ranked as a high-yield account, the minimum balance required to earn the advertised rate cannot exceed $25,000.
Okay, that keeps out the ultra-wealthy exclusive accounts.
Right. But, more importantly regarding those teasers, they disqualify any account that caps the rate at a balance of less than $5,000.
So if the high rate stops after $1,000 or $2,000, it's just out.
It's out. Because for a serious saver, someone trying to park an emergency fund or a down payment on a house, a $1,000 cap is useless.
Yeah, you hit that cap immediately and the rest earns nothing.
Exactly. It's a gimmick. The rankings are trying to serve as vehicles for wealth preservation, not just clever sign-up bonuses.
Okay, let's pivot. I want to talk about the world of CDs, certificates of deposit.
The lockbox of banking.
Right. This is where you lock your money up for a set time to get a guaranteed rate. And this is where I feel like the marketing gets even more aggressive.
Oh, absolutely.
Specifically with the word jumbo.
Jumbo. It sounds massive. It sounds like you're getting the VIP treatment.
Right. I assume a jumbo CD pays a better rate because I'm giving them more money. That's how bulk buying works at Costco, so it should work at a bank, right?
That is the logical assumption. But the source material explicitly warns about the fake jumbo.
The fake jumbo. What is a fake jumbo?
So first, let's define the terms according to the methodology. In this system, a standard CD is anything with a minimum deposit up to $25,000.
Okay.
A jumbo CD is defined as requiring a minimum deposit between $50,000 and $100,000.
Okay. And what about the super rich people?
Super jumbos, $250,000 or more, aren't even tracked by this system. The market is just too small.
Got it. So we are looking at that $50K to $100K sweet spot for jumbos.
Right.
So where does the fake part come in?
The researchers found that many institutions will market a jumbo CD that requires a $50,000 or $100,000 deposit. But when you look at the APY,
Let me guess. It's the same.
it is exactly the same as their standard CD that you can open with $500.
Wow. So you are locking up 200 times more money and getting zero extra benefits.
Zero. And the methodology says these are not really jumbo CDs. If the rate isn't higher than what you get for a standard deposit, they completely disqualify it from the jumbo rankings.
That is a brilliant consumer protection filter. Because I would absolutely fall for that.
A lot of people do.
I'd think, well, I have the 50,000, I should put it in the jumbo to be safe. Not realizing I'm losing flexibility for literally no reason.
Exactly.
Yeah.
So what we call a lazy tax.
Yeah.
The bank is hoping you won't bother to check the standard rate. The ranking methodology does the checking for you.
That's great. Now with CDs, the main trade-off is that the rate is fixed, right? You lock it in.
That's the core feature.
But I've definitely seen variable rate CDs advertised. Are those allowed in these rankings?
Generally, no. The rankings ban variable or flex CDs where the rate tracks the prime rate.
Why is that?
Because the consumer doesn't know what they're actually buying.
Oh, right.
If the prime rate drops next month, your CD rate drops. The ranking is supposed to be a projection of guaranteed earnings, and you can't project that if it's variable.
That makes perfect sense.
But there is one exception.
Oh.
The bump-up CD.
How is a bump-up CD different from a variable one?
A bump-up CD guarantees a base rate, say 4%, but gives you the option to increase it if market rates go up.
Okay.
Usually you get one bump during the term initiated by you.
So the rate can only go up, not down.
Correct. It's no-lose variability. Since the base is guaranteed, the ranking system allows it. It's a feature that only benefits the saver, unlike a variable rate, which really just protects the bank if rates drop.
Right. Now, one thing that drives me crazy when I'm CD shopping is the weird terms.
The odd month promos.
Yes. I want a 1-year CD, but a bank is offering a 13-month special. Another offers a 7-month promo. How do you even compare those?
It's messy. The ranking methodology solves this with what they call duration grouping. This is really helpful to know so you don't get confused looking at the final lists.
How broad are these groups?
Surprisingly broad. If you look at a 6-month CD ranking, it actually includes any term from 5 months up to 9 months.
Wait, really? So a 9-month CD is competing against a 5-month CD in the same list?
Yes. And a 1-year ranking covers anything from 10 months all the way to 14 months.
Wow. So if I see a bank at the top of the 1-year list, I really need to check the fine print. It might be a 14-month commitment.
Exactly. That extra 2 months might not matter to you at all, or it might be a total deal breaker if you need the cash for, say, a wedding in exactly 12 months.
That leads us perfectly to what I think is the most fascinating part of the document, the algorithm.
The real secret sauce.
The tiebreakers.
Yeah.
Because these days, rates are incredibly competitive.
Yeah.
You might have 5 banks all offering exactly 5.00%.
Right.
So who gets the #1 spot?
This is where the methodology reveals its true values. It's not random.
Okay, so for savings accounts and MMAs, if the rates are tied, what wins?
Accessibility. The first tiebreaker is the ongoing balance requirement.
Okay.
If Bank A requires you to keep $10,000 in the account to get the 5%, and Bank B only requires $500,
Bank B wins.
Bank B wins.
Lower barrier to entry wins.
Always. If those are still tied, they look at the lowest initial deposit.
Yeah.
So how much do you need just to open the account? Again, easier to open ranks higher.
And if they are still tied after that?
Alphabetical order.
Really? Alphabetical. Well, boring, but I guess you have to pick something.
True. But for CDs, the tiebreaker is completely different. And this is probably the most critical insight for anyone listening who buys CDs.
Okay, lay it on me.
If 2 CDs have the exact same APY, the tiebreaker is duration. But specifically, shorter is better.
Shorter is better.
Yes. If a 6-month CD and a 9-month CD both offer 5%, the 6-month CD is ranked higher.
I think my instinct would be the exact opposite.
Most people think that.
I'd think, oh, I can lock in this good rate for longer. That's better.
It's a very common misconception. Think about it from a liquidity standpoint. Time is money, right?
Right.
If I can give you a 5% return on your money and you get your cash back in your pocket in 6 months, that is objectively better than waiting 9 months for the same annualized return.
Because once I get it back in 6 months, I can reinvest it.
Exactly. You have options. You are free.
Yeah.
By tying your money up for an extra 3 months for no extra yield, you are paying an opportunity cost. The ranking system basically penalizes the bank for holding your money hostage longer without paying you for the privilege.
That totally reframes it. If the rate is equal, time is the currency.
Perfectly put. Time is the currency.
Now, everything we've discussed so far, the tiebreakers, the 40-state rule, that's the standard operating procedure. But the source material mentions a significant evolution that happened recently.
Yes, specifically on January 1st, 2025.
Right.
This was a major shift in philosophy, a real adapt or die moment for the rankings.
What exactly changed?
Well, think about how banks have been trying to incentivize loyalty recently. They started creating these complex tiers.
Oh, yeah.
You get 5.5%, but only if you have a checking account with us and make 10 debit card transactions a month and have a direct deposit set up.
The hoop jumping accounts, I hate those.
Everyone does. Prior to 2025, the ranking methodology was purist. It said no.
So they just ignored them.
If a savings account required a checking account relationship, it was disqualified. It just didn't make the list.
Because it's annoying.
It is annoying, but those annoying accounts started offering the absolute highest rates in the market.
So by ignoring them, the best rates list wasn't actually showing the best rates anymore.
Exactly. They were artificially hiding the winners. So on January 1st, they changed the rule. Now, accounts with relationship requirements like direct deposit or transaction counts are included in the rankings.
So the velvet rope got lifted a little bit.
It did, but with a caveat. The requirements must be explicitly noted in the ranking. They can't ambush you with it.
So for us, as listener looking at these lists, this means the list is more complete, but it requires us to be a lot more vigilant.
Correct. It shifts the burden of, is this worth it? From the ranker to the reader. You now have to decide if setting up a direct deposit and swiping a debit card 10 times a month is worth an extra 0.25% in interest.
And that really brings us to the big picture here. We started this deep dive thinking a top rates list was just a simple spreadsheet of numbers.
And we found out it's a heavily filtered, curated ecosystem.
Right. It's filtered by safety, that FDIC requirement. It's filtered by accessibility, avoiding the fake jumbos and the teaser rates capped at $1,000.
And it's filtered by utility, making sure a money market account can actually write a check.
But I think the most important takeaway is actually in the conclusion of the source document itself. Despite all this math, all these algorithms and tiebreakers, they admit the choice is deeply personal.
Right. They mentioned that their rankings typically include 15 or more options. And this is where the human element comes in.
Yeah.
Maybe the bank at number 1 offers 5.10%, but the bank number 7 offers 5.05%, and you already have a mortgage there.
And you know their app works.
Right.
And you don't have to upload a photo of your driver's license again.
That matters. The cost of friction is real.
It brings up a really interesting concept you mentioned to me before we started recording today. Efficiency versus loyalty.
Yes. It's the final thought I'd leave with you, the listener. This methodology we just analyzed is ruthless.
Very ruthless.
It rewards pure math. It has zero loyalty. It will ditch a bank the second its rate drops by 1 basis point.
But we aren't algorithms.
We aren't. So you have to ask yourself, is chasing an extra $20 of interest a year worth the hassle of opening a brand new account at a bank you've never even heard of? Or is there real, tangible value in simplicity?
It's the sleep at night factor versus the maximize every penny factor.
Exactly. The rankings tell you what is mathematically best. Only you can decide what is practically best for your life.
So next time you see that best of list, remember, there is a massive machine behind it fighting to keep the marketing traps off your screen. But you are still the one who has to press the button. Thanks for diving in with us today.
Always a pleasure.
See you on the next deep dive.